and welcome to Options Guide TV. My name is Brian Overby. I'm the author of the Options Playbook, and I'll be your host for about the next 30 minutes here on Options Guide TV. So on Monday, the markets were closed. We did an Education Monday. We talked about a covered call on steroids, and in particular, we looked at it in NVIDIA because it was a trade that we actually placed or paper traded inside the Options Guide TV platform. And we discussed the setup of the trade, why we did the trade, everything that went along with it. We just went into a deep dive into the strategy that I like to call covered calls on steroids. All right, so we did not get the opportunity to talk about coin. Coin is Coinbase, which is an exchange that focuses on cryptos, but does a lot more than that. And usually the stock goes as crypto goes. And the company announced earnings, and it was very odd in that the company ran up big, ginormous, heading into the earnings report, and then reported earnings, and then proceeded to give that large run right back. And the trade that we had on was profitable, and then turned out to not be profitable when it was all said and done. But ideally, you would have just got out of the trade. So I guess in order to show this, we need to go to the Tradier Pro software, and we need to highlight the actual movement in the underlying stock. So here is a chart, and I'm going to zoom in a little bit, and let's grab this corner. So this is what Coinbase. Oh, no, this isn't Coinbase, I was going to say, because we're going to talk about Baidu too. But this is what Coinbase has done over that short period of time. Here's the big run up that we had. So the underlying stock, from the day that we put the trade on, which was a Wednesday, they announced on a Thursday. So what ended up happening there, then we got the 14th and the 18th is here. Okay, so the market hung out, did well on Thursday, finished close to its high, or going into the earnings report. And then this is Thursday, and the market ran all the way up to this recent high, which was right around the 300 level. And it honestly, like if you look right across the top of these candles on all these, now this is a short-term time frame that we're looking at, and then it just announced earnings and boom, gave everything back and went right back to where we started. So this is a run up from this spot, 275, 25 points up to 302. Most of the volume was right here at right around 300, and then closed down and ended up down on the day right back where we were, right at 275. So it's kind of like, did it really happen? Right? Did the move really happen? So the trade that we had on was profitable, and I would have closed it going into the close and not taking the risk of the earnings report. Now, you needed the volatility crunch in order to make it at more profitable, if you will. And that's the reason why we were doing the trade. We did it on a Wednesday. We normally would do the setup on a Thursday, and that would have been a bad thing because the market ran up. So you wouldn't have adjusted the trade as well. Let's just ride without the camera then. Okay, here we go. Let's just go full screen. Let me pull this back. And we're going without the camera today. Here we go. So here's the trade that we have. Here's Coinbase. Stock was at 280. We this was the setup that we had. So when we put the trade on, the stock was at 280 or 268.86. We bought the 280, sold two of the 290s, and bought one of the 297.50s. So this was a broken butterfly in that this distance on our long spread for our butterfly was 280 to 290, and then we went short on our short spread, and when we only went from 290 to 297, so that's 7.5. So there's 10 points here and 7.5 points here. So if we look at this trade, that was done for $1.25, very inexpensive, and mainly because there were pumped up implied volatilities. If you look at the implied volatility inside the Tradier Pro option chains, you see that the option contract that we were selling was 135% implied volatility. Now the stock ran all the way up to 300 and a little bit beyond. So there was opportunity on Thursday to get out of the trade at any point in time. And but you did not get the decrease in implied volatility that would come after the earnings event. But the trade would have been profitable without a doubt. You paid $1.25 for that trade. You look at the most at the money option contract that was trading for $10. So these values would have increased precipitously because they would have became at the money option contracts. And that trade, you could have got out probably for a double or even a triple on Thursday. Now they announce earnings, market comes down. If you wrote it into the earnings, then the market closed at 275. So it came all the way down back through, and you would have had a little bit of time to maybe try to adjust the trade. Let me pull up the Tradier Pro software one more time here. Second. And you would have, at this point in time, you would have had time because it came all the way down through our strikes again and then closed down here at the 275. But if you wrote it all the way to the expiration on Friday, you would have been out of luck. So there were many opportunities to trade. The fact that we couldn't talk about it on Monday was kind of an issue because the markets were closed and we taped the show. And so with this scenario, just interesting trade in Coinbase in general. If you're still bullish on crypto, Coinbase is a way to play the crypto market. And you're buying a real company. You're buying a company that has strong management team. But a lot of times with Coinbase, though, it just really tracks what's going on with Bitcoin and the other cryptos. So if the other cryptos are doing well, Coinbase has a tendency to do well. A lot of people treat it as a crypto, but it's an alternative. Now they have ETFs on cryptos and stuff like that. So it's not as important, Coinbase, but I always traded Coinbase personally as an alternative to trading crypto. All right. So today now, after all of that, we'll keep this back up. Let's go and look at Baidu and see what happened with Baidu. BIDU. Baidu was in the news a lot. Mark Tapper was talking about his hedge fund and portfolio and getting bullish on China because basically looking for opportunities, saying everything's been beaten up with the tariff talks and everything, and just want to get long-term bullish on some of these Chinese stocks. And Baidu is the Amazon, if you will, of the Chinese marketplace. They've recently talked about, Apple's been talking about some deals with them. They've been in the news a lot. But once again, they announced earnings and the stock dropped precipitously, and it's continuing to drop a little bit. But we're at a range right here at the 88 level. Let me pull up the chart on Baidu. That looks interesting to me. There's a lot of noise right around this area, and here is a gap. Now, you could say to yourself, if it breaks below this level, all right, then maybe there's a potential to fill the gap all the way down to the 84 level before you hit a little bit of support. But I kind of like the concept of just selling some premium. The implied volatility ran up very big running into the earnings. After the earnings, the stock went down. The implied volatility was very sticky. It's still trading at around 62%. Well, now we're at about 58% with the historical at 50, and we kind of drift down to the 50 level. So there's still some implied volatility in the option contracts. There's still some premium that we can sell. And so that's what we're going to do. We're going to actually go out and sell a put spread on Baidu and see if this support area holds. And then also I want to look at potentially just getting bullish on the underlying stock. So I might look at 2 trades in this scenario. Okay. So let's start by looking at what the put spread would look at. And I already have this in the what if calculator. Yep. So here's the put spread that I would like to look at. We're going to focus on this area in the chart, and we'll know quite quickly after today if we can get the stock to finish above the 88 level, basically above where it's at right now. It's down $1.81, 88.33. If we can finish somewhere close to that, be nice to get a little bit of a bounce up. I kind of feel fairly comfortable with this trade, thinking implied volatility could still come in a little bit because we had that big earnings report and such a increase in implied volatility. So we're selling vol and we're selling some time decay. So we're going to look at Baidu. We're going to go out 16 days and we're going to stay fairly close to where the market is at. And we're going to look to sell a shorter term short put spread to help pay for our butterfly. And I don't mind waiting on the butterfly to put the trade on, but you can put it all in one day, but that's quite a bit for just one trade. But we here on Options Guide TV are doing things a lot just to learn. So I'll put both the trades on today, make them paper trades. I wouldn't necessarily do that in my own account, but we'll put it all on today just for the show. So we're going to come in and we're going to sell the 80. We're at 88. I guess we could do the 86. Let's do the 86. That's close enough to where the strike is at. March 16th expiration, March 7th expiration, 16 days away. We're going to sell the 86 strike put and sell that for $2. And then we're going to go down to the 82 strike put, and we're going to buy this option contract. I'm going to click that ask. Okay. So now we're bringing in a net credit of $1.27 to the account. And we're hoping that holds. If we can get some follow through on that, get a little bit movement to the upside, then I'm going to do a broken butterfly on the upside, only because I really want to keep the costs down on the upside trade. So we're neutral in that if the market just kind of stays where it's at, we're going to be okay. But if we definitely need the market to go up. And if the market goes down, our maximum risk on the trade will be 4 points wide, which are the spreads, minus $1. Let's call it $1.30. I like that number right there. So that is going to be $2.70 will be our max risk on the trade. That's where that midpoint is at right now. So this will be, and I'll send this one to the what if calculator. This will be our official paper trade for the next 16 days. And then we're going to add this trade to the position. Like I said, I might have, I'd probably wait on this a little bit, see if we do get the hold on the short put spread. I don't want to add additional risk, but it's going to be very inexpensive if we're doing it just on a one contract basis. So let's take this trade out and let's send this to the trade ticket. And we'll go back to the trading tab. And now we're going to stay in that same expiration, and we're going to look to do a broken butterfly. The higher implied volatility vols trading right around that 50%. Just higher implied volatility in general, and Baidu makes butterflies a little bit cheaper. And we're going to get 5 points here in that we can buy the 90 strike at this point in time. We might adjust it if you waited a couple of days to see if you get a bounce back. But then you buy the 90 strike, sell 2 of the 95s, and buy 1 of the 97s. Okay, so now this is a broken butterfly, broken wing if you want to, but we are long 5 points on our long call spread, and we are only short 2 points on our short call spread. That means that the difference, which right now is 3 points, is what the butterfly would trade for. If we did nothing to this trade and the market took off, the butterfly and the stock was above the 1 standard deviation move, delta's 22 on this, you would end up at least being able to sell this butterfly for $3. You might be able to sell it for somewhere closer to $5, depending on the movement of the underlying stock. Implied volatility coming in would help if you're correct on your forecast. If we get a bounce back, a very interesting trade, but a lot of parts to it. I'm not really going to adjust the trade. There is an adjustment we could do on the butterfly, but we have so many legs on the trade, and we got to pay commissions, we got to pay bid-ask spreads, that if I put this trade on and it goes against me, I'm going to close out the trade. If it goes with me, I'm going to close out the trade. That's just the way that I'm going to approach it. It's only a 16-day trade from beginning to end. All right, so here is the second section of our trade, and I'm going to pretend that we put them all on today, and I'm going to take screenshots of both of them, and we'll look at both of them during the week. Let me grab a little bit of water here. So if I look at the what if calculator, here is what breaking the wing on the butterfly does. Stock is here at 88. We'll pull it down. We put this trade on. This is $1.08. So we're literally getting it done for a dime, I guess. $1.08 at this point in time. We'll call it $1.10. We did the short put spread for $1.27 net credit to the account. So that actually puts our risk just on the whole position at the $4 if that support doesn't hold on by due to the downside. If not, on here, we're using the net credit from the short put spread to pay for the butterfly, and that was my goal. That was my intention. And if we get the market to bounce somewhere between 90 and 95, make a little bit of a bounce up, implied volatilities come in, we can make a few dollars on this trade. Remember, if you make $3 on the butterfly, you're doing well because you have a cost basis of 0, and it's not a home run trade. The market takes off, goes all the way up to this side, and all of a sudden it's trading at 100, where it was prior to the earnings, where the big decent sized run up heading into the earnings report, where the stock was at. So once the stock, if it bounces all the way back to that level, you see that the butterfly is going to trade for at least $3 at that point in time. So we got a chance for it to trade for 5. And if it blows the number, or if it just blows away the market to the upside, it's going to also trade for 3. We're selling the put spread to pay for the butterfly. We have 0 cash outlay, but we do have a margin requirement because we have a 4-point wide put spread that brings a risk onto the trade. So a convoluted advanced trade, but I like the trade. I think it's interesting. I would normally sell the put spread, make sure that the support holds right at the 88 level. And if that does, then I would look to put on this butterfly, maybe have to adjust it up to the 91 strike if the market bounces back a little bit. But that's the way that I would approach this trade. Any questions that you have? If you have any questions, I'm happy to address them. Sorry about the technical difficulties today. All right. Well, I guess we'll leave it there. That will be our trade for the day, and we'll leave you with the position in Baidu. The Coinbase trade, the options have already expired. You would have had to trade out of the position. If you fell asleep on the position, it would have went out worthless. So that was a tough trade. You would have had to watch that one along the way. But then again, if you're doing anything around earnings, you always have to keep an eye on it. You do want to trade that trade. And then also with the Baidu trade, we're selling a put spread to try to pay for a modified butterfly. That's it for this edition of Options Guide TV. And we will be back on Friday for the next edition. We'll see if that 88 level holds in Baidu. And we'll come up with a plan for what we're going to do the week after. So thanks for tuning in. We'll see you this Friday at 11 a.m. inside the Tradier Hub, hub.tradier.com. And see you Friday.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.